LiteFinance, the world of financial freedom.
Hello, it's Monday, 10th of July, and it is time to start the market forecast, in which we will discuss, of course, main macro events from the calendar and summarize fundamentals that are driving the markets with focus on Euro and USD, so that at the end we will prepare a trading plan for the Euro-USD currency pair. Okay, let's begin with the calendar as usual. On Monday, traditionally, we don't have any major events happening. Even FOMC members' speeches aren't that important this time since we got minutes last week and the picture is rather clear at this point. On Tuesday, we will get labor data from the UK and inflation data from Germany. On Wednesday, early in the morning, RBNZ will publish their interest rate decisions, which shouldn't bring any changes. At least, that's what consensus of analysts is predicting. Later that day, we will get inflation data from the US and Bank of Canada interest rate decision, where BOC is expected to raise rates by 25 basis points. Thursday, we'll start with the UK GDP and industrial production numbers. Next is data from the US about inflation on producers' side, which is a leading indicator of a CPI, and those numbers, as you can see, are steadily declining. On Friday, no major data will be published, so we can move on to the fundamental summary. The higher the expectations, the harder it is to meet them. After ADP's report showed the private sector employment surge by nearly 500,000 in June, investors were hoping for a super strong US labor market report. However, this did not happen. Non-farm payrolls rose by 209,000, falling short of Bloomberg experts' forecasts and showing the worst dynamics since December 2009. However, if you look closely, the Euro-USD rally looks illogical. In fact, the figure of 209,000 by historical standards is very strong. It confirms that the labor market is not cooling as fast as Fed officials would like, especially since the unemployment rate fell from 3.7 to 3.6%. Now it is far from the June FOMC forecast of 4.1% for the end of 2023. The consensus estimate by primary dealers is 4%. In December, these figures were 4.7% and 4.6% respectively. So both the Fed and the banks that work directly with it are well aware that there is still a lot of work to be done. The acceleration of the average salary to 4.4% also does not help the Euro-USD bulls. The indicator is increasing at a much faster pace than before the pandemic, which suggests big problems in returning inflation to the target. Indeed, it was easier to reduce prices from 9% to 4 or 5% than to push them towards the 2% target. Both the Fed and the markets are aware of this, and this is why the June US jobs report did not cause a sharp decline in the changes of a federal funds rate hike to 5.75% or more in 2023. So they remained at 36%. And the jobs report didn't collapse treasury yields or drive stock indices up. With such an environment in the financial markets, Euro-USD should not grow, especially so fast. Most likely, the Euro-USD rise is not based on the US jobs report, but on expectations of a slowdown in consumer prices to 3.1%. So this figure looks very close to the target. Most likely, it was not based on an increase in core inflation to 5%. Such CPI dynamics allow hedge funds to get rid of the US dollar. Last week, speculators became net greenback sellers for the first time since March. And according to Bannockburn Global Forex, the release of US inflation data will be a turning point. So the Euro-USD decline in the second half of June was a correction to an uptrend. The main USD index downtrend, which started in September to October, will resume. So as long as the US labor market and economy remain overheated, inflation will not be defeated. The Fed will continue to tighten monetary policy, so the Euro-USD rally looks excessive. Even if the pair rises at the beginning of the week on expectations of a serious CPI slowdown, sell it on the facts. The inability of the euro to return to the resistance at 109.65 and consolidate at it indicates that the bulls have weakened much earlier. It also serves as a reason for entering short trades. And so, That would be all from my side for today. Thank you for watching and goodbye till next time.